Deflation might sound like a good thing, but what if it is actually a trap that hurts your savings? Dive in to see why deflation, despite your intuition, is bad for the economy and your savings. So, what exactly is deflation? Simply put, it's when the prices of most things like groceries, clothes, and even houses start to go down over time. That might sound great at first, but it can actually cause some problems. See, deflation isn't just the opposite of inflation. Inflation means prices are generally going up. Deflation means they're going down. There's also something called disinflation. That's when prices are still going up, but not as fast as they used to. For example, imagine Priya, an economics student, buys a textbook for $50. If there's inflation, that same book might cost $55 next year. With disinflation, it might cost $52. But with deflation, it could cost $48. Now, why is deflation bad? Well, when prices are falling, businesses often make less money. They might have to cut wages or even lay off workers. This is especially concerning for someone like Sarah, who's saving for a house. If wages go down, it becomes harder to save. Plus, if businesses are struggling, they might delay investments in new equipment or technology. This can slow down the entire economy. Another issue is that deflation can make debt more expensive. If you owe money but prices and wages are falling, it becomes harder to pay back that debt. This is a big worry for someone like David, who's concerned about the impact of deflation on his investments. You see, a lot of how the economy works boils down to supply and demand. Supply is how much of something is available, and demand is how much people want it. The price of something is determined by this simple logic. When there's a lot of something and not many people want it, the price goes down. When there's not much of something and a lot of people want it, the price goes up. Economists call this sweet spot the equilibrium price, but things aren't always that simple. Sometimes one company controls the entire market like a monopoly. Think of a small town with only one grocery store. That store can charge higher prices because people don't have anywhere else to go. High prices or low prices also depend a lot on the government's actions through monetary policy. One way the government can impact the economy is by changing interest rates. Interest rates affect loans and mortgages, which are critical parts of how people interact with money. See, central banks use interest rates to manage inflation and deflation. If inflation is too high, they might raise interest rates to discourage borrowing and spending. If the economy is slowing down, they might lower interest rates to encourage borrowing and investment. And even when prices should be changing based on these pressures, sometimes they don't. This is called price stickiness. For example, it might cost a restaurant money to reprint its menus, so it may keep prices steady for a while even if its costs go up or down. High inflation hurts those with cash savings like Robert, who is on a fixed income because that cash buys less. But those with debts could benefit. Deflation is the opposite, hurting businesses while helping consumers who might delay purchases. Geopolitical events and war always throws a wrench in these economic conditions. Political instability, trade wars, and military conflicts disrupt supply chains and cause economic uncertainty. These events can lead to higher inflation, lower economic growth, and significant welfare losses. For example, a war can disrupt the supply of oil, causing prices to spike. Elections can also have a big impact. A populist government might implement policies that disrupt trade or increase government spending, leading to market volatility. These events cause the Geopolitical Risk Index to spike. This index measures geopolitical tensions and the probability of adverse events. To see how stable prices actually are, economists rely on numbers. One important number is the Consumer Price Index, or CPI. This tracks the price of common goods and services, so we can tell if things are getting more or less expensive. Economists also watch the Producer Price Index, or PPI, which measures price changes from the seller's point of view. While we've covered a lot, there are still some questions that need more exploration. How do government regulations really affect price stability? What's the best way to handle supply chain disruptions? And what are the long-term effects of new technologies like AI on inflation and deflation? These are just a few areas that need more research. If you found this video helpful, please like, share, and subscribe for more videos that untangle the world of finance. By staying informed, we can all make better financial decisions in an ever-changing world.